Hello, my name is Andrew Thake from Minds and Money, and joining us today, we've got a keynote panel discussion on what would be the key ESG themes and trends that miners and investors need to focus on as we transition to a decarbonised green economy. Joining us are four esteemed panelists. We have John Howchin, Secretary General of the Council on Ethics of the Swedish National Pension's AP funds, Matthew Fifield, Managing Partner of Pacific Road Capital, David Williams, Environmental and Social Department of the European Bank of Reconstruction and Development, and Sharon Flynn, Executive Vice President and Head of External Affairs and Social Performance of Oceana Gold. Welcome to you all. Perhaps I can just sort of kick off with a couple of general sort of opening questions. And the first one is to Matt Fifield of Pacific Road. How do you consider ESG factors when judging whether or not to invest?
Sure, great question, Andrew. Look, we at Pacific Road, we're a mining specialist. So we look at mining companies all day long. There are 9 key areas that we're looking at. We're looking at disclosure, a couple of things that are mandated and legislated, which are corruption, human rights, and indigenous rights. We look at tailings, air, water rehab, health and safety, community relations, and diversity. And then we're also looking at carbon with an increasing specific carbon strategies with an increasing rate at the moment. I think one of the most interesting things right now when we engage with companies, sometimes they're early stage and sometimes they're late stage producers. There's a level of sophistication that grows from an early stage mining company to a broad, more diversified mining company. And we're trying to gauge where people are in that process. So in one level, we're backtracking to what we think are essential risks and talking about them and seeing, are they relevant? Are they material for this particular company? And if so, do they have a plan and a strategy? And frankly, are they communicating it to the market and to investors or internally? And so part of it is a gauge of risk, but increasingly we're also looking at opportunity. And I mean that specifically as it relates to carbon, where people that are focusing on their scope 1 and scope 2 emissions now as material producers are some of the more sophisticated companies are looking at that as a way to add value and gain access to strategic capital and partners along the journey, knowing that their scope 1, scope 2 emissions have an impact downstream from them. And so, I think that a lot of the times, although this is probably a poor metric, we're seeing where people are on the journey, because some people have started it and begun it and started thinking about ESG as a strategy and a strategic growth initiative, and other people are at the beginning and trying to figure out where they, what do they want to do, and what do investors expect, and how do they want to internalize that?
I saw, John, you were nodding your head as Matt was answering that question. Where do you see mining companies on that journey? And I guess the supplementary question is ESG seen as a risk control or a value creation function by mining companies?
So I think that was an excellent answer by Matt. And Matt is very close to a lot of mining companies out there, and I agree with a lot of things that he raised. But we all know, many of the large mining companies have been on this journey for quite some time. I've been looking at them for over 20 years now, and they've had their ups and downs. And unfortunately, I think for a number of these companies, the journey stops a bit too early. And we've seen a number of issues popping up because you sort of get into a comfort zone. And you think you have this in control, and you do mistakes, and I'm not going to raise any of them, but you all know that these companies do these mistakes. So I think it is important that you come and start seeing the opportunities, and you start seeing this as a business driver and not as a risk control, because I do think when it starts become a positive, and I'm really in the group where it has to become a positive because the way the world is looking, I do think you avoid that risk of losing sight of why you do this. And I think the best mining companies we see out there, they have already understood this. But it is a tricky journey, to Matt's point, and we're quite keen to remind all mining companies, but obviously especially the big ones, because we have large holdings in the big mining companies, to keep it up and keep going. And it can be hard work on a continuous basis, but yeah, you have no choice.
John, one thing that I would say, apologies, Sharon, is that at the beginning, 4 years ago, 5 years ago, when we started in on this journey, it was a little bit lonely, and our discussions were seen as somewhat fringe in terms of talking about this. And if you just reflect for a moment and you look back in time and where we are today, it's very mainstream. It's a very common topic to engage with people. Sophisticated mining companies have specialists that are thinking about this all day long, which is helpful. And then the environmental pressure outside of us as, say, equity investors that are coming from all sorts of stakeholders and the lending community and all of the rest, there's so much more ambient pressure that is creating winners and losers in this category, that in some ways it can be very confusing, but it's also very helpful because it's just a part of the discussion, whereas 4 years ago it was not.
Let me bring in Sharon. Can you just tell us about OceanaGold ESG policy?
Yes, well, thanks for that. I really like this metaphor of journey. It very much is a journey, and also thinking about this idea of risk versus value creation. What I've found within companies, that risk many times is the only way to really get the attention of senior executives and people in the company. That's really what they will understand and what makes a lot of sense to them immediately when it comes to potential effects on the business. But the understanding and approach and sophistication across all of the areas that comprise ESG are vastly different. So when it comes to health and safety, for example, or even just safety, say, companies are very sophisticated, and senior leaders really understand that. They probably understand a little bit less health. As you move into environment, certainly that makes sense to them. But still, here at OceanaGold, we're working on maturing our approach to managing environment. But when it comes to, for example, communities and social performance, many companies, you'll only see a sophisticated approach in general in the majors where they've been paying attention to this. And it really needs to be built up. So I don't think it's a one size fits all, and you have to be working across the range of issues. And what I found is that's important when you say, well, what is our ESG policy? We don't have a set single ESG policy that's going to cover the range of all of those issues. But what makes sense is to always come back to reminding senior leaders, it's about avoiding and mitigating your impacts on our people, on the communities where we work, on the environment and the societies in which we operate. And then second, it's about contributing. So if, for example, COVID, recently we've all had a challenge with COVID, we need to mitigate the effects in the workplace, do as much as possible in the workplace to make sure that people don't get sick when they come to the workplace. And then we need to contribute by working with local governments in the Philippines to support the distribution of vaccines, to support access to vaccines, and to support our employees in actually getting the vaccine. So this idea of a journey, I think, is an excellent way of thinking about it. There is no utopia at the end where everything is wonderful and peaceful, and then you get to stop worrying about it.
Let me bring in David Williamson of the European Bank of Reconstruction and Development. We've talked a little bit about risks so far. Is it a question of understanding risks, or are there ESG red lines which can compromise a project's ability to access capital?
Well, thank you for the question. I think fairly predictably the answer is both. I suppose coming from the institution that I do, we're in a slightly unique position, being a publicly owned, privately investing institution. So our kind of policies and our view of ESG is very governed by our shareholders, which are a number of sovereign governments. So we we have red lines which come from that background. There are certain types of issues that, frankly, we just can't touch and can't go anywhere near. But within the institution itself, our department, we actually sit within the risk area. And ourselves as an institution, we very much view ESG as not only a governance-based issue, but also a risk issue as well. Recognizing, of course, that the other end of the spectrum from risk is opportunity. We very much view a project that we are financing as an opportunity for community partnerships, as an opportunity for developing capacity within governmental institutions and regulators, as well as developing the capacity of our industrial partner as well. We tend to work in the SME space. It's not very often that a major mining company needs cash from a financial institution, especially one from a relatively small institution such as ourselves, although it does happen sometimes for political reasons. But we view the ESG journey with our clients as a partnership. We require all of our projects to meet international best practice. We require all of them to meet local regulation and EU regulations as well, which are developing fast. And in particular, those regulatory drivers coming out of Brussels, when you're looking at the standards that are required in governance, and also the transparency that is now required of companies. There has been a sea change over the last few years, and Matt was indicating the types of change that he's seen over the last 4 years. Well, I've been doing this since the early 1990s, and frankly, for the first 10 years of that, you were just banging your head off a brick wall. Clients sometimes bought into it because they thought it was a nice to have. Well, it's not a nice to have anymore. They absolutely must have it, and it's not just the regulators that are requiring it. In fact, the sources of finance are requiring it as well. It's a different ball game, and there's a new sheriff in town.
And when you are meeting these mining companies, are they prepared with adequate information and policies? And I guess the supplementary, if they are falling short, where are they falling short?
We see a huge range. We have clients coming to the door with fully implemented policies and procedures. We have clients coming to the door with nothing. As I said, and to kind of maybe exhaust this metaphor, it very much is a journey. We will pick up with our clients where they are along the path towards a fully functioning ESG structure, and we will work with them to put it in place. For us, it's the endpoint that's key, not so much where the client is when we first have that first discussion with them. Obviously, it's beholden on us to make it very clear to those clients exactly where the endpoint is and what they will need to be doing. But we work in developing economies sometimes with Western-based clients, quite often with locally based clients. So we have a duty, being the institution that we are, to help them along that road. We've got the resources and we've got the relationships, we hope, to enable them to do that.
Bringing in Matt, have there been transactions which Pacific Road have been involved in where the economics were attractive, but where you've walked away purely on the basis of ESG grounds?
Oh, for sure. Yeah. And usually though, what I would say is that the upfront screening that you do in terms of negative screening, or just when you sit down and talk to somebody and say, tell me about how you run yourself, tell me about could be corruption, could be your community engagement, in particular Indigenous is something we spend a lot of time when that's a relevant factor. And we never, if you're talking about it in terms of a deal, a lot of times you never even get to the point where you're figuring out if the price is right. Because if it's you're really just backing away and saying that's too tough. Another thing that's interesting is when you talk about value add, what we're trying to achieve with our portfolio companies, particularly the ones where we have material influence, is to bring them along the journey. And I've been in dozens of conversations where someone like Sharon's organization will come in and they'll say, oh, thank God, this is a team that I can put in front of my board because they actually know how to run how to run the business. This is a suitable counterparty because they've thought about what's important to us as an acquirer, or they've thought about what's important to us as a customer, or whatever it may be. And so so for sure you walk away from things pretty quickly when when things aren't right. And that's kind of the negative aspect of risk management, and that's the screening. But the inverse is also true, and it's the piece that I just wish I could get across to the mid-sized market, is that your options open up materially when you are prepared and at least somewhere on the journey and can articulate what your plan is. Have a plan. Doesn't need to be the best one, no, but if you have one, it's encouraging because people will then be able to risk assess your plan, and they want to know about it, whether they're buying 10% of your company or 100%, or frankly, the way that we're tracking, whether they're buying your product that you produce. And that's, that is only going to continue, where customers and strategic partners are going to become much more discerning. So showing up and being able to articulate wherever you are is important. That's also one of the reasons that we focus on disclosure, because disclosure is a door opener. It's not the end all be all, but it's a door opener that get companies thinking in the mode of what other people need to know about their business. A lot of the times, particularly early stage mining companies, are very focused on their fence line and what's controllable. And a lot of the stuff that we're talking about today actually isn't controllable definitionally. Doesn't mean you shouldn't try to set up systems to risk assess and work around in the uncontrollable environments. So that's the graduation in thinking from uncontrollable, from controllable fence line tons grade costs to uncontrollable. How's my community feel about me? Am I doing a perception survey? Am I getting channelized information from my community relations managers? Those are the types of things that actually bear incredible fruit and open up those strategic windows down the road.
You talked about disclosure there, and I'd just like to bring in Sharon Flynn. Sharon, there is a preponderance of disclosure standards and reporting venues emerging. How do you decide which to subscribe to, and which, from your perspective, are the key standards to adhere to and report on?
Well, I think what I've always said is companies have to do the work to figure out what all of the standards mean. And there certainly are companies that are going to try to find that single standard that somehow checks the boxes across all of the issues that we've talked about, from health and safety to political complexity to climate change. And it just doesn't exist. So I think that's why there's a number of standards. So we use GRI to produce our sustainability report. We look to the ICMM for best practices. We look at the IFC for the resettlement standard, and also for their approach to managing impacts. We're a member of Transparency International, and they have an excellent approach to actually taking a look at the systems that you have internally to manage bribery and corruption. What else? UN guiding principles on business and human rights, the absolute best practice that we've found incredibly useful to figure out how to codify and put together a management system and do training internally around the importance of business and human rights, climate change, TCFD, the Global Tailing Standard. So we have a standalone management system that we refer to as our responsible mining framework. And we do the work to build standards that reflect the best practice across health, safety, environment, diversity and inclusion, climate change, et cetera, in those standards. So companies have to do the work to keep up with knowledge, to keep up with what's being determined to be best practice. And if they're looking for a single framework, they're probably not doing the work that they need to do to actually manage their impacts and effects properly.
I saw John.
If I can just chime in,
yeah.
If I could chime in for a second, Sharon, that's a very mature approach, and I'd love to introduce you to a few people so you can share it with them. What we found is we did an awful lot of work trying to figure out what is it that we want, And in fact, we came back just like you did and said, right, okay, GRI, SASB, EITI or TI around these different areas actually have great leverageable resources, and they are really open to work with people. And so it's not on our side to, come up with a new best practice, or it's really how can you say what's material to OceanaGold or whatever the company is, and then reach out and find those best practices.
Yeah.
So there's no one shoe fits them all.
Yeah.
Actually, if I could just jump in here as well, just with a couple of thoughts. As ESG is growing, as always with something that in certain areas is deemed as new, there's a lot of people jumping in, and a lot of people looking at standards. The standards are just proliferating. There's almost an explosion of them at the moment, and this in itself is a risk. Industry needs to kind of consolidate around a common standard, and frankly, that's probably never going to happen. But at least you have to have an approach towards it. Certainly in our area. I mean, Sharon, you mentioned IFC. All of the multilateral development banks, we all work together to try and narrow down on a common approach. There won't be a common standard, but at least there'll be a kind of series of common objectives. And if we're working with clients, there's this proliferation of stuff out there. Let's throw in the Sustainable Development Goals and TNFD, which is coming down the line as well, and there's going to be more. Mm-hmm. So when we're having conversations with clients, it's very much around what you're saying. I hate the word bespoke because it kind of has other connotations in there. But take a look at your risk exposure, take a look at your operational risks, mm-hmm. and put together a system of managing and reporting that works for you, but also tells the public and the investors the information that they need. Unfortunately, there isn't something where you can walk into the shop and say, "Can I have 4 of those, please?" That doesn't exist at the moment. You have to put together something that works for you and your stakeholders.
Yeah. Mm-hmm.
I think.
Does that mean that does that mean then, David, having some sort of standardized form of disclosure is kind of hard for the industry to go towards, or?
No, I mean, disclosure is going to happen, and obviously, there are increasingly some regulatory requirements around disclosure as well, depending, if you're listed or where you're listed, and obviously you've got to tick those boxes. Things will evolve, mm-hmm. such that you'll be able to compare apples with apples rather than at the moment it's kind of apples with pears, really. It will evolve. It will get better. Everyone's learning. And as long as everyone appreciates that everyone, including ourselves, have been doing it for a while. We're all on a learning curve here, and some things are going to work and some things aren't. But we'll experiment, we'll make mistakes, but in the end, I think we'll be in a better place.
John, I wasn't sure if you wanted to add something there.
I think it was a brilliant list that you mentioned, Sharon. I really liked it. It's a bag of goodies you mentioned, and I think you missed out on EITI, but Matt added the EITI. But I think to your question, Andrew, I think the main problem you have is that all of these issues sort of have an own underlying process, how they evolve, how they change, how expectations change, which makes it all difficult to put all those bag of goodies into one bag and think, oh, we're going to have one process to manage all of these. There's different dynamics to all of the issues and all of the things that Sharon mentioned that are driving them and changing between sectors. So I think it is a bit of wishful thinking that we're going to have one solution. To your point and to David's point, I think there's a proliferation of too many standards. On national level, sometimes regional level, local level, you can have for different sectors, etc. And there is a drive within the investment community to simplify this, especially from the investment community, that we don't have too many asks, that there is a similarity between the asks, because quite frankly, at the end of the day, people like Sharon, you need to focus on quality. Mm-hmm. And if you get too many asks and you can't really focus on the quality of the message and actually do the proper work that you're supposed to do, I think this is going to backfire. And there's been overload, demand overload on this issue for many years for many sectors. So we've got to be mindful of this, and we've got to keep clear of what we want and kill a few darlings along the way as well, which we're trying to. So,
okay, thank you very much for that. I'd like to move on to COP26, which is obviously going to happen this November in Glasgow, and probably to John first, and then to Sharon. Will COP26 have any impact on mining? If so, what?
well, mining is, this is a huge opportunity. Everybody on this call knows that the climate transition is the biggest opportunity you will ever have. This is the biggest driver for the mining sector you could dream of. So do it right, and it will be a very successful sector. So obviously, whatever comes out of COP26 will have an impact on the mining sector, because climate change is driving the mining sector, whether you like it or not, and it will continue to drive the mining sector for a long time to come. Having said that, I think the flip side of that is that expectations on what we're talking about now will rise even higher. I think a lot of people on this call are already a bit tired of what we've just discussed. I'm tired of this journey. I'm tired of all the questionnaires. I'm tired of everybody asking me stupid questions, what have you. But the realities are that mining is going to be very much in focus, because you're going to be so important. There's going to be a lot of political issues. There's going to be indigenous rights issues. There's going to be land rights issues. There are going to be water issues. There's going to be every kind of community impact issues all over the place, with all these mines that we're going to need for the climate transition. Mm-hmm. So yeah, COP26 is important, absolutely, but the issue of climate change is the biggest opportunity for this sector that there's been for a very long time.
Mm-hmm. Sharon, what's your perspective on COP26?
Well, I would say OceanaGold, we're already on the climate change journey. And so I'm not so sure that COP26 in and of itself is going to specifically change the journey that we've already started as a company and the work that we need to do. What I think will be interesting to track, and that I would hope would eventuate, is how the global climate change journey changes the jurisdictional contexts and what governments are committing to. So we work in New Zealand, which has a Zero Carbon Act, 85% renewable energy sources. They are super focused to concluding reaching zero carbon in 2050. But then we also work in South Carolina, which has a much different approach to energy and renewables and emissions, or the Philippines. And so our challenge comes, so we can do all the work that we need to, internally, because we have 100% control over, to some extent, over diesel and emissions. But when it comes to power sources, we're absolutely bound by what's actually happening in the jurisdictions where we're working. And so New Zealand helps us in our journey. The Philippines, 50% coal-derived power. We have very little control over that, absolutely nothing. And also, South Carolina is primarily nuclear, but at this point is still figuring out what is going to be their renewable energy journey. So I think that how jurisdictions and governments change their approach is going to be very beneficial. If they can come along with us on the climate change journey, then I think that would be the best outcome. And that's going to take a while, I think, to come to fruition.
If I had a concern about the mining industry's approach to climate change, just thinking out aloud, it might be more towards the junior end of the spectrum. And I don't have definitive figures sort of for this, but I guess in the course of my day job, I speak to a lot of Australian juniors, but a lot more, I guess, North American based sort of juniors. I guess that one concern that I know this is a kind of a question that I've got, that I sometimes do worry a little bit, that at the sort of junior end, especially when I'm speaking to, I guess, Vancouver-based sort of miners, is that often they just don't quite get, or they don't quite believe in sort of climate change. I'm not too sure whether either David or Matt, whether sort of you'll face similar sort of experience of that when you've been talking to some sort of junior end miners that don't seem to get climate change, or would you disagree with my statement?
Well, look, I think that it's, from my perspective, what you're talking about is that's sort of the journey that we alluded to earlier. One thing that we have done, Andrew, is we go out and do a quick survey of where people are, in terms of their public disclosure. And it's a very discernible trend that junior mining companies really don't talk about sustainability, don't issue transparency reports, and large companies do, right? And that's interesting. But there is also jurisdictional differences. And you'll find that Canadians, in part because of the Canadian environment and interaction with First Nations and a number of other things, are much more, they adopt disclosure earlier in their life cycle, and it's been that way for 3.5 years of surveys running, and it's very discernible. And Australia is lags. It's been catching up, but it lags materially in terms of early stage disclosure. So look, that sort of evades the question of climate change, but it does come to kind of where people are on the journey. So there is a regional difference. In general, Canada is well ahead of Australia, and I don't really have enough data series just to see that change in London versus the other two markets. The thing that I will say is that more and more juniors are starting to think about climate, again, going back to their scope 1, scope 2 emissions, how they feed into the energy supply chain, and therefore how they show up as a potential value add, because there's a lot of pressure right now across the globe to deliver carbon reduction. And there's a real value proposition for people that are attacking that item now and can deliver meaningful different results on their commodities, say by 2030, or by 2025 or 2030 or even 2035, when people are working against 2050 targets. So the steel chain is remarkably interesting right now, what people are doing in the steel chain. The cement chain, very interesting how people are thinking about carbon and clinker reduction in that area. And that's being led, of course, by the majors, but it trickles down pretty fast to the juniors. And so you'll see a bunch of different savvier juniors that are looking to attract investors and capital to their project, which they desperately need. Their juniors, and they're using their positioning on a carbon adjusted cost curve as a tool to do that. So it's happening. I'm seeing it every day.
I saw David, you were just nodding your head as kind of Matt was speaking. I'm just interested in your thoughts of that, and do you find there's any geographical bias in how in how companies differ?
To be honest with you, our kind of client base probably isn't large enough to be able to see a geographic bias. We work with North American-based companies, Australian-based companies, and kind of locally based companies. I don't think there's certainly from our experience, there's a kind of a rule of thumb as to what the attitude would be based on the geography. There's always a surprise sitting around the corner when you meet, a very sophisticated Mongolian mining junior. They exist. Similarly, you could come across a company that's been listed in Toronto for 25 years that, frankly, they've just about come to the end of class 101 in this stuff. There's a huge spectrum. Looking at this issue, how does climate change affect it? To be honest with you, it's been a long time since we've had a conversation with a denier. And frankly, if we did have one, it would be a very short conversation. We look at these issues through the lens of European Union objectives and European Union regulation. And you take a look at that, and there's a lot of requirement in there to look at issues such as circular economy, to look at issues such as energy efficiency, to look at objectives such as decarbonisation. And all of those really must feature in the projects that we're looking at. We work a lot on strategies for decarbonisation. both at the national level, but then also down through sectoral and into individual project. And you know, the new thing that's coming down the line in our sphere is Paris alignment. And this is something I think which will definitely be driven by COP26. You know, we have made public statements that every single investment that we make from January the 1st, 2022 is going to be Paris aligned. So we've had to very rapidly come up with methodologies so that not just at the national level, but at the individual project level, we can make a determination as to whether that project enables a country to meet its objectives under the original Paris Agreement. You know, it's a rapidly developing area, but all of the MDBs are working on this, and it's something you'll see rolled out over the next 6 months. And we're going to be applying that not just to individual projects where we're providing capex. We're also going to be looking at in the equity space as well. So, you know, there's a lot of work that's being done at the moment behind the scenes, but, you know, from our point of view, everything we do from now on is going to be viewed through this climate lens.
One thing we haven't touched on so far is tailings, which is obviously very, very important. Tailings, loss of life and environmental damage are arguably the most visible issues damaging public perception of mining. How well, in your view, is the mining industry moving from a desire to never see such incidents again to action to ensure that they don't reoccur? Who would like to take a stab at answering this question? John?
I'm happy to start.
Okay.
Oh, sorry.
Sharon, please.
Yeah, so we certainly, I think the global tailing standard is an excellent step forward as sort of a first step. I think, as we were talking about with any standard, the challenge is in the take-up and the challenge is in the implementation. And so it's only going to move performance broadly across the industry if companies adopt it and if companies succeed in actually implementing it. And that certainly is not something that's going to happen overnight. And I think one of the absolute best things about the global tailing standard is the formal inclusion of all of the social bits, fully understanding the consequences to communities of catastrophic failure. And that is also the area, I think, that in general, the mining industry is the least equipped to deal with. And certainly what I found in talking to tailings experts is they have a particular way of working that has a significant focus on safety, but it's in a bit of a black box. And so trying to articulate the need to do upfront community engagement, upfront assessment of social impacts, to consult, engage, and work with communities who would be around the tailings dam, I think is going to be a challenge. So it's going to be a challenge, but I think it's also an opportunity because it's really going to help drive social performance into the mining business. So I think it's a great addition to the industry, and certainly we have reviewed it in detail and are looking to integrate and adopt over time. But it's not something that's going to happen overnight, and there's still, I think, a lot of work that needs to be done.
Okay.
John, you have to say something.
Do I have to say something, Matt, on this?
You have to say something.
I have to say something. Well, I've been one of the masterminds behind this standard, so I have to say something. No, I'm very pleased to hear what you're saying, Sharon, and as obviously we're following all the ICMM members who are implementing or trying to implement this standard now, and there will be a lot of outcomes on practical. I'm a very hands-on person. There will be a lot of practical experiences which will be shared through ICMM and externally as well on how to implement this standard, which I totally agree is going to be a bit of a work in progress, and it is a work in progress. But we're setting up an independent institute with UNEP to oversee the implementation and to get truly third-party independent verification of this implementation of that standard, so you can get it verified. And we're expanding the database that we've built where all the tailings dams will be disclosed on a global basis. So it's very, and just looking at the recent events in Angola/Congo, the diamond mine, we all see that this issue is not resolved by any means. And back to my previous point, and this was a really good response on the discussion we had last week, is that we have a lot of legacy dams, and they are in different qualities. We know that there are some really good dams and there are some not so good dams. But if mining is going to expand the way we all perceive mining is going to expand, we're going to have a lot of new dams, and we have to make these dams right. There can't be any excuses if we start making these dams and we don't do them right. So still a lot of challenges on this topic, I would say.
My next question, and I'll ask it to David first and then Matt. Remuneration. When it comes to moving from desire to action, executive employee KPIs are arguably a key tool in directing effort and behaviour. Do you consider the integration of ESG into KPIs to be sufficient, excessive, or inadequate, and why? David, do you want to have a crack at that first?
Yeah, look, that's a difficult question. And certainly looking at it from our institution, it kind of crosses a number of areas there, and perhaps it would be a driver for ourselves to take a look at how we look at this issue, because you are looking at the environmental side, the social side, the governance side, but you're also looking at the reputational side, you're looking at the finance side. We do look at remuneration, and we do look at the individual KPIs. Obviously, at the client level, we're not in the game of telling clients exactly what their remuneration structures should be and what sort of rewards they should put in place. But overall, if we are looking at the performance of a project, then we will have specific KPIs in place that relate specifically to ESG. And we do that through a number of routes. We have our policy requirements, and where work is required by the client, we actually agree an action plan with them. And from that action plan, KPIs fall out. We may even have specific KPIs put in within the loan agreements or the framework agreements or the subscription agreements, depending on whatever relationship you have with the clients. But on each and every project that we work on, there will be ESG specific KPIs that are attached to that. And we monitor those, sometimes through self-reporting from the client. Sometimes we monitor performance ourselves. And on occasion, we have independent consultants do it for us, depending on the kind of risk level that we look at. But as I said, each and every project has specific KPIs. And we try and ensure that our clients deliver on the promises that they're making when they put these projects together.
Matt?
So Andrew, that's a devilish question. So I commend you on that. It is nearly impossible to make a unilateral statement in response to that, because everything tends to be case specific. Unlike David, and probably more like John, we're shareholders, and shareholders have a voice in boards and on compensation. And I guess that if I were to make a unilateral statement, I would say that compensation schemes, by and large, are wholly inadequate in terms of everything that we've talked about, the increasing demands on executives who have complicated jobs, then in terms, and then as that mounts, there's, reference our entire conversation, whether it's standards or tailings implementation or this and this and this, the complexity and the need to dedicate resources to be on the journey, to be moving in that direction. Right now, that conversation honestly is a lot of stick. It's a lot of stick and very little carrot. And I think one of the most interesting places that this actually rolls up is to the board, because in a way, as a shareholder, I follow shareholders elect the board to follow a strategy, board sets the strategy and hires the executives to implement it. And if you think about the position that board members sit on, which often has a lot of liability attached to it, you're asking them to show up and do all these things, most of which they know only a little bit about. And to master all these new tasks, I for one, I'd be happy to be accelerating the conversation so that in 5-10 years, this is standard behavior. And if that takes compensation that is linked through at the board level, or generally chief executives are linked. I was talking to a multi-asset producer, sub $500 million market cap, and he said, look, about a third of my compensation is linked towards purely towards ESG, of which safety is a small component. And that's a story that repeats itself again and again. Now, the other thing is interesting is nobody talks about it, right? Nobody lets you know that this is happening behind the scenes. So boards are linking executive comps. And as you go on the journey, what happens is first you measure, then you set targets, then you set performance-based targets that are linked to compensation. That's a pattern that just goes as people go on the journey, because you can't set performance targets without actionable data, and you can't set actionable data without knowing what the data is. So people go on that journey, and eventually it ends up with sophisticated performance management KPIs that go down all the way down the line to shift bosses and all of the rest. But at the highest level, the reason I think it's inadequate is that we're still in a conversation that really centers on stick. And so that means that you will get one class of people who will opt in to avoid the stick and position themselves. And that's generally, let's say top 50 mining companies, ICMM members. You can kind of see the different flags that people will fly that will say, I'm on this journey, I buy into it, I want to avoid the stick and get access to capital, right? Or to strategy. But then there's a huge universe of people that are out there that are going, how do I do this? That's probably our most frequent question is, how do we get on the journey? I'm just confused. I don't know enough about this. You seem to know a lot more. Can you introduce me to John Howchin or Sharon Flynn or David Williamson to give me a leg up along the way? And that's where having an incentive scheme that says, don't just believe me, this will hit you in your wallet if you're behaving in that manner, I think is an incredibly powerful tool that the investment community isn't using right now.
Just bringing in Sharon, at Oceana Gold, am I right in saying that the remuneration and incentives there are linked to ESG KPIs?
Well, for this year, we actually set a good portfolio of corporate KPIs. So in that sense, the compensation remuneration of everyone across the company is linked to that. And that has covered the suite to some extent of ESG. So health and safety, TRIFR rate, intensity, environmental incidents, but we also have human rights completion around, actions, closeout actions on human rights, impact assessment, action plans, human rights training, climate change, and we also have a corporate KPI around social change assessments. So that's our pragmatic approach to putting together social baselines in operations that never really had a social baseline to begin with, nor an assessment of social impacts. Diversity and inclusion, along with the typical, financial performance corporate KPIs. So I think that's a great first step. I feel like I confused myself. Certainly, a couple of you start thinking about KPIs and you go, oh, it's so complicated. How do you do that? But really, you just set them, right? You just say, hey, I want to set a corporate KPI on these things. Let's include these across the company, and so we did. So I think it's, again, a journey, and we have to continue to move forward and see what works and what doesn't. But I really feel like now, we review those. We just reviewed those corporate KPIs with all of the senior leadership just yesterday. And it's a good way to get people focused on it, because in the end, the people on the operations, the people doing the day-to-day work really need to buy in and understand why they have to take an online human rights training.
Just time for one last question, and I'm going to direct it to John. If we were to pick one key ESG theme or trend we're going to see in 2022, what would it be and why?
Ooh, I think Indigenous people is going to continue to be very much in focus for many reasons, not only for mining, but land on the whole is becoming a hot topic, and we want to expand wind power, we want to expand solar power. To Sharon's point previously, mining companies will want to do that as well if they want to get carbon neutral organizations, and if they want to run their business in a carbon neutral way. And most of this previously unwanted land is actually owned by indigenous peoples. They've been pushed out in all over the world into these uninhabitable places. And we've already seen this issue being on the table. As we all know, we're not going to raise the case. And it will continue to be in focus, I would say. And you will need to have your community profiles in place and your impact assessments and the right people helping you with navigating these issues. And they're all very special. So start looking at that, I would say.
Well, I think we're kind of out of time. So all that remains for me to do is to thank Sharon Flynn, David Williamson, Matt Fifield, and John Howchin. Thank you very much for your time.
Thanks,
Thank
Andrew.
you all.
Thank you.